Hey everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into a topic that hits close to home for a lot of you out there living the global life. Whether you're a digital nomad, a remote working professional, or an expat executive, if you earn in one currency and invest in another, you're not just managing wealth, you're managing complexity. This episode is all about how to invest as an expat. We're talking currency risk, taxes, international portfolios, emerging market strategies, Sharia compliant investing, ESG. Yep, we're covering all of it. And as always, no fluff, no filler, just real, practical insights you can act on. Let's get started. Why expat investing is different. If you've ever tried to follow traditional investment advice as an expat, you've probably realized fast it doesn't really fit. That's because it assumes you're living, earning, and spending in the same country. But when you're living in, say, Dubai, earning in pounds and investing in US stocks or Thai real estate, your financial life is anything but standard. You're exposed to multiple systems, multiple risks, and multiple opportunities. And that means you need a different playbook. Currency exchange, the double-edged sword. Let's kick off with one of the most overlooked, yet critical, factors for expat investors: currency exchange. If you earn in one currency and invest in another, currency fluctuations can seriously impact your returns. Imagine you're earning in GBP and investing in US stocks. If the pound strengthens against the dollar, even a good year in the SP 500 could look flat once you convert those gains back. And the reverse? You could get an unexpected windfall if the pound weakens. So what can you do? First, use multi-currency brokerage accounts. Platforms like crystalballmarkets.com make this super easy. You can hold and invest in multiple currencies, which helps you avoid unnecessary conversion fees and lets you be more strategic. Second, look into currency hedged ETFs if you're investing in foreign equities. These are great for limiting downside from currency swings. And third, this is important, keep your emergency fund in the currency you spend. If you're living in Thailand and paying rent in baht, don't lock all your liquid cash into USD denominated assets. Keep your daily life insulated from FX volatility. Taxation, the expat headache. Now let's talk about taxes, because if you get this wrong, it can wipe out a big chunk of your investment gains. Cross-border taxation is complicated. Some countries tax based on citizenship, like the US. Others tax based on residency, like most European countries. Then you've got bilateral tax treaties, which are supposed to prevent you from being taxed twice, but only if you claim the benefits properly. So here's what you need to know. Figure out where you're a tax resident. This determines where you owe tax on income, capital gains, dividends, everything. Understand tax treaties. For example, India and the US have a treaty that limits dividend withholding tax to 25%, not 30%. But to get that lower rate, you need to file Form W. 8Ben if you're investing in US assets. Work with a tax pro who understands expats. I cannot stress this enough. General accountants usually don't know how to optimize for multiple tax jurisdictions. Hire a specialist. Building an international portfolio. One of the best things about being an expat, you're already thinking globally, so your portfolio should reflect that. This is where international diversification really shines. Here's how to think about it. Developed markets. Allocate to stable economies like the US, Europe, Japan. Use low-cost ETFs like the SP 500 or MSCI World. Emerging Markets Investment 2025. Look toward high-growth regions like India, Vietnam, and parts of Africa. These markets carry more risk, but they also offer significant upside. Real estate abroad. Invest in property where you plan to settle, retire, or where rental yields are strong. EU countries, Southeast Asia, even Latin America can be good picks. Fixed income. Think about currency exposure. You can buy inflation-linked bonds like US, TIPS, or global bond funds in local currency. Alternative assets. These include commodities, private equity, or crypto. Great for hedging against traditional market risks. Crystalballmarkets.com offers tools to build and manage a global portfolio across all of these categories, and their platform supports multi-currency trades and easy rebalancing. Specialized investing, ESG, Sharia, and inflation. Let's take a moment to explore three focus strategies that matter to a lot of global investors. 1. ESG investing. If sustainability is part of your strategy, ESG investing, that's environmental, social, and governance, lets you align your values with your returns. You can invest in ESG ETFs that screen out fossil fuels or unethical labor. Use scoring systems to evaluate ESG risks. Tune into an ESG investing podcast to stay ahead of regulatory trends. 2. Sharia compliant portfolios. For Muslim investors, Sharia investing means avoiding interest, riba, excessive speculation, and non halal industries. Your tools: Sukuk, which are Islamic bonds, halal ETFs screened for compliance, Sharia compliant robo advisors that manage your portfolio according to Islamic principles. 3. Investing during inflation. We've seen major inflation spikes recently in India, Turkey, Argentina, and beyond. So if you're based in an inflation-prone country, here's how to protect your capital. Gold, especially if you're earning in a devaluing currency. Real assets, like real estate or infrastructure funds. Inflation-linked bonds, like India's capital index bonds or US. Tips. And yes, search trends show people are actively looking up phrases like investing during inflation India, which tells you this is a growing concern for global investors. Real-world expat scenarios. Let's bring this down to earth with three real-world examples. Scenario 1, investing in US. Stocks from India. Use the liberalized remittance scheme to send up to 250,000 US dollars per year abroad. Open an account with an international brokerage that serves Indian residents. Watch out for US estate tax thresholds, which apply above $60,000 in assets if you're not a US citizen. Scenario 2, investing in India for foreigners. If you're an NRI or OCI holder, open NRI/NRO bank accounts. Invest via mutual funds, stocks, or Indian real estate. Just note, foreigners can't buy agricultural land in India. Scenario 3, retiring in Portugal. Portugal's non-habitual residency, NHR, program offers a 10-year tax exemption on many types of foreign income, reduces taxes on pensions and capital gains, gives you access to EU-regulated banks and investment platforms. Choosing the right platform. Let's wrap this up with the biggest decision you'll make as an expat investor: where to invest. You need a platform that can handle multi-currency trades, offer access to global markets, be easy to use across time zones. Crystalballmarkets.com delivers exactly that. It's sleek, user-friendly, and designed for the globally mobile investor. And if you're looking to level up your financial literacy, I highly recommend checking out the Crystal Ball Markets podcast. It's perfect for beginners and intermediate investors alike, with easy-to-understand episodes covering everything from trading basics to asset allocation. That's it for today's episode of Financial Market Insights for Traders. Whether you're trading from Thailand, investing in India, or saving for retirement in Spain, remember, as an expat, your edge is that you already think globally. Now it's time to make your portfolio reflect that. If you found this episode helpful, share it with a fellow nomad or investor. Subscribe for more no-fluff insights on investing, trading, and building wealth across borders. I'm Sophia, and I'll catch you in the next episode.